This episode is proudly sponsored by ShakePay, Canada's easiest way to buy and earn Bitcoin in 10 minutes or less with no deposit or withdrawal fees. It's so easy, even the boomer can do it. Guys, I've personally been using ShakePay for several years and highly recommend them. Their mobile app makes it super easy to buy and sell Bitcoin. All you have to do is e-transfer directly to your ShakePay account and you're ready to go. So head over to shakepay.com or download the mobile app, use the referral code Loonie Hour and get $30 of free Bitcoin when you sign up. ShakePay gives out free Bitcoin to every user every day just by shaking your phone. They call this the shaking sats feature. It's awesome. I highly encourage you to go check it out. ShakePay has also just launched one of Canada's only Bitcoin cashback prepaid credit cards, which gives users up to 2% Bitcoin cash back on every transaction. If you want to opt out of Canadian dollars and start earning rewards through Bitcoin, go check out ShakePay. Once again, guys, that's shakepay.com. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 51. As always, joined by the three amigos. We've got Rich Diaz at Acorn Macro Consulting and Keith Dicker of IceCap Asset Management. Welcome back to the show, gentlemen. We've got Rich, who's back in high school, back in the locker room. Where are you, in Portugal right now?
Back in the Portuguese high school locker room. I hope I don't get stuffed into one of these lockers, but by my cousins who are farm boys and they're pretty strong. Yeah, back in visiting my mom. I didn't get to see her over the summer, so she insisted I come over here. And
I thought she was in Montreal.
I know, but she's a globetrotter. She's a boomer, man. She's got all kinds of cash and nothing to do with it. So she just gallivants all over the world, spending her hard-earned money, and that's it. So I'm here now in Portugal, enjoying myself.
Keith knows what that's all about. Keith, what's new?
I also have all kinds of cash, but I don't travel anywhere. I just stay here.
Keith has the only house in Halifax that didn't get impacted by the hurricane.
That's right.
Yeah,
not one shingle was lost.
Yeah, we had a lot of damage here, but it's really tough, guys. There's a lot of damage to people's properties. I think there was one soul what was lost over in Newfoundland. I know one town in Newfoundland, I think about 90 families are completely displaced right now. So, a lot of people are struggling over here in this part of the country. So we have that going on. So just, everyone, always think of other people all the time. And
well, you got Hurricane. Yeah, you've got Hurricane Ian, obviously, in Florida there. And was it? I don't know if it was real, but there was someone was posting on Twitter there that was it was like a shark on the highway.
Saw that.
I don't know if that was real or not, but that's pretty nuts.
It's pretty cool, though.
Yeah, must be an investment theme in there of some sort. Maybe today, and not to sort of make fun of the storm, but the night before our storm, Mrs. IceCap and I actually watched The Perfect Storm. So remember you guys probably don't remember. You guys were too young then.
I've seen that movie. It's great. Isn't that Mark Wahlberg?
Yeah. And Steve, is actually based on a book. I know you don't read books, but it was based on a book as well.
I don't know how to read.
Yeah, Sebastian Junger. But we watched that movie the night before. And, I think there are some parallels with that and what we have happening today. Because I think I remember a couple of weeks ago, I said, wow, this is the most exciting week in the investment world in centuries. And here we are 2 weeks later, and I'm saying, this is even more exciting than it was 2 weeks. So, let's use that analogy with the perfect storm, because that's the kind of guys we are. We're deep thinkers.
Is that the movie that you watch and you're like ready for like the market to crash? That's quite interesting. I'm more of like a Big Short guy.
No, I don't watch any movies that have a sad ending. I only watch movies that I know have a happy ending.
I think The Big Short's got a happy ending.
Rich's favorite book is Grade 7 Basic Math.
With one appendix. I think my favorite book is
So,
I don't know.
yeah,
Okay.
probably going to be a slow podcast this week. Really, not a whole lot to talk about. Not much going on right now. It's mayhem out there, Keith, and this is obviously continues to sort of gear up every single week. And it's funny on the podcast. I think we joked about it last week, which was like every week we come on here and be like, well, something's going to break. It hasn't happened this week, but we're getting closer. We're getting closer. And it looks to me like we finally broke something. It was the Great British Pound.
And the guilt.
Yeah. I mean, Rich, I don't know if you have any, you've been living in the UK, so I don't know if you have any frontline thoughts, opinions, but maybe I'll let you sort of unpack that.
Wait, Rich.
Okay, sure.
Rich, you're innocent. You shouldn't feel guilty at all.
I mean, when I did move there, a certain head of state kicked the bucket right after. So my mother hasn't stopped letting me think about that. Anyways, okay. So the UK came out with them. So the UK's had a leadership election after Boris Johnson was unceremoniously kicked to the curb after lying and being just a general scumbag. And then Liz Truss was one of the two potential Conservative Party leaders. She ran against Rishi Sunak, who was the Chancellor of the Exchequer. Anyway, so Liz Truss is okay. Anyway, so she came out with a mini budget, reduced the tax rate to 40 for the highest income bracket from 45 to 40%. She wanted to cancel a corporate tax increase that was going from 19 to 25, I think. And she wanted to cap some kind of energy prices. All this to say is the market was not impressed. It was not funded at all. The market was not impressed. The pound fell. I think we got to 105, Keith, something 107 or something was the low. And the gilt, which is what they call, instead of the Bund in Germany or the Treasury in the US, they call UK bonds gilts. Don't ask me what that acronym means. It's just add that to the list of acronyms that I don't remember what they stand for. But anyway, so the gilt soared, the pound fell, which is basically another way of saying there was a run on British assets, so to speak. And I think as recently as yesterday, was it, that the Bank of England basically had to come in and intervene in the gilt market, basically promised to print unlimited amounts of pounds in order to buy any gilts that are on the market, and basically to halt the sell-off in that market. And they had to do that because, if I'm not mistaken, it was pension funds that had all kinds of shenanigans, these levered products, in order to gain that incremental sort of return. And a bunch of I mean, I don't know exactly how many, but a few pension funds were basically going to go bankrupt, belly up. And so that's just a really, really fascinating story. So that's my little synopsis. I've got a history lesson attached to this, but I'd like to hear Keith or Steve.
Yeah, well, let me quickly chime in there. We've got this is from Robert Smith, who writes about for the Financial Times. He says, senior banker describing the leveraged unwind in gilts as coming close to triggering, quote, a Lehman moment. Asset manager accused the Bank of England of ignoring calls to intervene sooner. And so in the interview, the guy was quoted as, at some point this morning, I was worried this was the beginning of the end, said a senior London-based banker, adding that at one point on Wednesday morning, there were no buyers of long-dated UK gilts. It was not quite a Lehman moment, but it got close. And then he goes on to say, it appears that some players in the market ran out of collateral and dumped gilts. We were more conservatively positioned and we had enough collateral to meet all of our margin calls. But the Bank of Canada warning that it needed to intervene in the market, otherwise it would seize up. But the bank failed to act until Wednesday and declined to comment. So, I mean, in terms of things breaking, I mean, to have your country's pension system near almost collapsing is really quite something. So, Keith, I would love to hear your comments from the financial side.
Yeah, and probably the main thing, just to add to what you guys just described, which is perfect. What happened in the UK bond market? So, for the gilts or the treasury bonds, if you want to call them that, they actually went no bid. So everyone was selling them because they had to raise money, to meet margin requirements and other structures. The other thing with pension funds, pension funds are a whole bunch of assets, but they try to match a lot of these assets against future liabilities that are coming up. So then when you have big swings in interest rates, it can really knock your liability matching off sides, and that's what happened. So when these margin calls were going, they weren't margin on the stock market, like they were margin on interest rate products and swaps and things like that. So they're all selling their most liquid asset, which is supposed to be the UK Treasury bond, and it just got to a point where there was no bid. So if you think about that, so that's what happened to the Japanese a few months back.
What's a bid, Keith? What's a bid?
Yeah. So there was a bid means we want to buy something. So if Rich, he's feeling guilty, so he wants to sell his guilts, he's offering it. That's the offer.
That's a real zinger there.
I like that one. That's a good one. And I think I got some pretty good bad jokes, but that was
Anyways,
okay.
Carry on.
Yeah. So, Rich is selling and I want to buy. I'm on the bid. But what happened that day in the UK, there was no one on the bid. Nobody was willing to buy, the British Treasury bond. So that's when the Bank of England, they had to step in and they had to do the buying. So that's what it was. And I know there was, it's really funny. I find, social media, it's great. And it gives me a good giggle every now and then. And, it was unlimited QE. That's basically what it is. They said, we'll buy enough as is needed to stabilize the market, which is unlimited. And some people were arguing, well, it's not unlimited. It's yield curve control. It's not QE. And I'm thinking, what the heck? You get all these guys just talking nonsense. But
I had some guy on Twitter DMs telling me that it wasn't a monetary policy. It was a fiscal policy update change or something, like arguing over basically semantics. Like, to keep things simple, it was QE. It's essentially unlimited. It's to create financial stability. Anyways, so Keith, continue.
But that's what's. Oh, go ahead. Sorry.
What did you say last week? You said you described old man yelling at the clouds.
Yells at cloud. Yeah,
that's from The Simpsons.
It's a classic Simpsons reference.
That's really funny. I like that. But so you have that happening. So that same morning you wake up, you have the Brits have to bail out, the gilt market. At the same time, the Koreans announced, they're bailing out their bond and FX markets. So now all of a sudden, and then the week before, you had the Japanese, they were trying to bail out their FX and bond market. So at the same time, again, like was this sort of perfect storm analogy that we introduced there earlier. You have the Chinese are desperately trying to, save their banking and FX market. You have the Japanese doing the same thing. And then the Koreans are making the same announcement. And then out of nowhere, the Brits come out and say, hey, we need some help here as well. So think right now, you're the Federal Reserve this week. So Powell, he's sitting there at his desk, he's doing whatever. And then the phone rings. It's the Japanese. They're saying, yeah, we have everything on it's stabilized here. We're selling all of our Treasury bonds to raise US dollars. And we're using that, to buy back yen. It looks steady, but we're still pretty rickety here. And Powell's like, okay, then all of a sudden, his office mate says, oh, you have the Koreans on line 2. And he picks up and he says, Koreans, we haven't talked to the Koreans since the 50s. So he picks up the phone. And here's the Koreans saying, yeah, we're having some trouble here as well with the currency side. So we have to support our currency just to let you know, because, we are your friend. If, any bombs start to drop, you're welcome to come over on our property. They have that happening. And then all of a sudden there's a call on the third line. Who was it now? He's with the Chinese again, just reminding you that they're in trouble. So don't be too aggressive with them. And he's like, okay. And then the other line rings and they say, hey, it's the Europeans on line 5 or 4. I don't know which one we're on now. And of course, Powell responds, the Europeans, which one? And he said, it's the Germans. And he said, oh, thank God it's not the French. And I'm sure that's a joke in there somewhere. You guys don't laugh at those.
Somebody,
that was not
there's
funny.
Probably one listener that might be laughing right now.
You just need to research, European war history and jokes on the French. Okay. Anyways, now the Germans are saying, hey, we're in trouble because bond yields are starting to rise and the Italian yields are starting to rise. And finally, Powell saying, my God, can it get any worse than this? And sure enough, line 6 lights up, and here are the Brits saying, hey, we have to bail out, our bond market today. So
Wait, they didn't bail out
is
the bond market. They bailed out the pension funds.
No, they had to buy the bond market to bail out the
but
pension funds.
Right. Okay.
Yeah.
We're arguing over semantics here.
No, we're not. No, we're in school. Rich, take some notes.
Well, no, I have some. I think speaking of notes, speaking of school, speaking of notes, I have a history lesson for everybody. So this is actually not the first time this type of thing has happened with pension funds specifically. So nothing is new, but what has been forgotten, to quote Marie Antoinette. In 1994. There was an Orange County, which is in California. Some of you may know there was a pension and investment fund, I think a pension fund. And it was run by a not particularly qualified guy, but he was running this pension fund for the Orange County, sort of all the people who worked there, et cetera, just like a normal pension fund, whatever. And he had leveraged positions. So this Treasury Secretary basically took on massive leveraged positions to improve the returns on the pension pot that he was running. And he grew, and you'll remember that before 1994, interest rates were falling. And so as the interest rates were falling, he took on more and more leverage. And he was renowned within this pension community for having such great returns, to the point where other counties that were neighboring counties got wind of this guy and were like basically banging down his door to give them their money in order for them to run it. So anyways, all this to say is, towards the end of 1994 or what have you, the Federal Reserve started a series of interest rate hikes, and lo and behold, these levered positions went from being extremely profitable to basically being wiped out, to the point where I think the entire county, Orange County, declared bankruptcy, and had to liquidate basically all their positions. I think this guy ended up spending only about a year in jail or what have you. But yeah, it's just, this is not the first time this kind of thing has happened. It certainly won't be the last. But I just thought that was sort of an interesting little history lesson for some of us who might not have been old enough to remember.
So I was old enough back then. I was working, of course. And didn't they make a TV series about that called The OC? Is that what that was about?
Oh no, that's about kids with iPhones and stuff.
But Keith, is this not like an important, like for you, is this not like an important like signal that like the fact that things are getting so bad that they went back to basically the typical playbook, which is print money, print the money, step in, and like I said, you said, the UK is doing it, Korea is doing it now, obviously the BOJ, but nobody seems to care about them because they've been doing it forever and they've never stopped. It just keeps kind of going on and on. Like, to me, it was a very important signal, more or less. So again, whether this is temporary or not, to me, it was just the old playbook, which people said, you can't do QE with inflation at 10%, but they did.
Yeah, so this is extraordinary. I mean, I know we can use that word a lot: shocking, astonishing, whatever you want to use, old man yelling at the clouds. But this has never happened in anyone's career before. Like this is highly unusual. Like the whole Orange County situation, like that was isolated to one small part of the market. They were running interest rate swaps. So they were, receiving fixed and had to pay out variable. So when rates went up, that's when they went under with the leverage attached to it. But again, right now, if you're an investment manager and you're not excited about what's happening today, you don't belong in the industry. Again, to have everyone in the world to have risk synchronized to this same degree. And again, I know there's a big discussion right now between, the developed world versus developing world. And the developing world, man, they must be chuckling right now, because it's usually those are the guys that are causing everything trouble everywhere else. but to have the Japanese and the Koreans are also in developed world these days, but to have Britain being really the first one to break, I mean that again, it's an unbelievable event. And I know, like, the trading day, as the trading went on, like it went to a risk on trading days, so the dollar sold off and everything else recovered quickly. It's our view. This is just a bit of a relief rally here. And, we'd always joke, this is a Thursday recording, watch this on Friday, but Friday, if you're watching this today, is September the 30th. So it's quarter end. And there's a lot of things that happen at quarter end people are not familiar with. If you're not inside the industry, but there's a lot of things taking place right now. And I suspect on Monday/Tuesday, when things get back to the start of Q4, you're going to see some continuation again, but nothing has been fixed right now. We continue to go down this path where, man, everything is broken. How do they fix it? What do they do? And I suspect the next step, what will happen, one of the American allies, they're going to announce that, they turned the swap line back on with the US Fed again, because everyone is just desperate for US dollars. They want that. But there she was. And this is, we continue to go to that space that's going to make a lot of people uncomfortable if they're not prepared for it. And that's where we're going. What do you got, Rich?
So, I was going to say, I'm excited for a different reason. So I'm less into the investment world and more into the macro and economics and history world. And I think what I'm really enjoying is, for the first time in a long time, we're having the rise of real interest rates. And a lot of the products, strategies, investments, stocks, bonds, real estate stuff that made a lot of sense in a world with negative real interest rates is not going to make any sense whatsoever in a world with real interest rates that are positive. So just to remind everybody, real interest rates are just, an interest rate, however you want to calculate it, minus some kind of inflation, again, however you want to calculate it. And, whether you look at break evens relative to the 10-year bond yield, which is now at I think a 4 or 5 year high. I mean, a 2-year high, on its way to crack a 4-year high, because the way the chart looks like. But, when you have when you have a decline in real interest rates, when you have real interest rates that are negative, lots of negative yielding assets make sense. Leverage positions make sense. Long duration assets that provide no cash flow, that are speculative investment, make sense. You think of the tech sector, or you think of think of like housing speculation, that starts to manifest itself. These pension funds that have leveraged themselves and have taken on these risky strategies make sense. But when real interest rates rise, it exposes a lot of this financial market funny business. And so for me, that's why I'm, I shouldn't enjoy it too much, because these are real people's lives and this is real money at risk. But for me, it's about freaking time that we have real interest rates that are positive. And my hope, and again, forgive me if I'm an optimist, but my hope is that central bankers have the, let's say, the intestinal fortitude to keep real interest rates high and positive, and to break something. Because I think, a lot of these issues with inequality and a lot of this populist bullshit, in my view, is a function of real interest rates. But I guess that's a conversation for a different day. But that's why I'm really enjoying that.
So the real interesting thing right now is, so in the investment world, you always price a market off of something else. And the base or the benchmark that's used to price every single asset in the world is really the bond market. So using the treasury market in the US, or your own local, government bond market, wherever you are, which is really a spread off the American market as well. But now we're into the situation where the price of these benchmark interest rate markets, they don't exist anymore. So what's the real price for, the 10-year gilt? Nobody knows. What's the price of it in Japan? Nobody knows. What is it in the US? We might think we know. What is it in Italy? Again, that's, I think now we're up to, are we at 5% now for the Italian 10-year? I think we are. And, that could be, so that could double the 10 very quickly, because the Italians had an election, which is another fantastic story, by the way. So, so the story with the Italian election, on basically on election day, the president of the EU, is it van der Leyen?
That's right. Ursula something, no?
It's van der Leyen, right? She's part of the van der Leyen
Ursula.
Industries empire.
Yeah. I didn't know she was part of the empire, but I should have assumed that.
Yeah, her family established van der Leyen Industries. And anyway, so she is an unelected official. And here she is telling the Italians on what they should do with their election. So you should not elect these guys and whatever. And of course, in the EU's eyes, the wrong party won, or the wrong coalition won. And, they quickly come out and they're threatening them. But again, it's just another example where, we have all these things that are offsides in the world. And I keep looking around, like, who wants peace? Who wants to sort things out? Get everyone together in the room and have a pint or a coffee, whatever, and figure things out. Like even this morning, I see like the South Koreans made an announcement, if the North Koreans fire one more missile over us, we're going to scream at the clouds again, something like that. But anyway, the Italian election should really pop up, because the Italians now, they're going to, and by the way, the party that won, they basically, I don't know the lady's name who won, and but she had some very aggressive rhetoric towards the EU and especially the French, and tell them to feck off basically. And at any moment now, this is what happens. So in Brussels and Frankfurt, they're getting together and they say, "Hey, have you noticed how the Italians, they just told us to screw off?" And yeah, we noticed that. He said, "What do you think we should do?" He said, "Yeah, let's pull off the Berlusconi trick again." So for people that don't remember, Berlusconi was the prime minister of Italy back, I think it was 2012. And so basically the Italian bond market went from like 4 to 6 to 12 overnight, and he refused to relent. He wanted to pull the Italians out of the Eurozone. And, Frankfurt and Brussels got together and they just starved him. Basically, they said, "We won't give you any more money." So do not be surprised to see the Italian 10-year all of a sudden go from 5 to 7 to 10 or something very quickly. And it's simply a function of Brussels and Frankfurt just putting the squeeze on the Italians to tell them to, get back in line. And that's happening as well. And again, this is great for markets. It's giving you a great opportunity
to
grow your wealth.
How do you see this shaping up here now? Obviously, with the stress is clearly emerging. Plain as day. Obviously, not overly surprising given where global debt to GDP is, and rapidly rising, surging interest rates, and how that was going to play out. It was really just a matter of time. But now that we're seeing things actually quote unquote breaking, Keith, how do you see this? Because I find it difficult to see the Fed pivoting, but if you continue on this path, things are just going to get really messy. So is this something where the Fed just ignores their counterparties and basically plunges, the global economy into recession or creates some sort of crisis in the name of fighting inflation? Or do they slowly start to abandon this inflation fight? What's your take?
Yeah, they're going to do a bit of both. So for example, right now in the UK and Eurozone, for example, they're raising rates and doing QE at the same time. So in the academia world, that makes no sense at all. You're providing stimulus or you're not, and they're doing both. So what I suspect what the Fed will have to do, and I mean, what the Fed will do, they'll either go in behind the scenes, which is what I suspect what happened when the Brits got in trouble there on Wednesday. They'll help. Now the Europeans are their friends. Like they'll help out the Europeans. They'll do that, or they'll announce, "Hey, the swap line is open," and they're always open, by the way. We have to officially ask. The phone rings. "Hey, can we draw money down, they'll say, yeah, of course you can. You're our friend. So you can see them providing dollars to the world at the same time continuing to raise rates. I don't think they're going to back off on raising rates unless something very dramatic happens. Because like for Rich will share with like in the economic world, like there's nothing broken yet. I mean, employment is okay. Growth might be
my thunder.
yeah. And but things, my view is like I'm really forward looking all the time, and I see the data is getting weaker and weaker, but it's not broken yet. Like that hasn't happened. And people say, well, I keep saying like the most dangerous private company in the world or non-public, like non-government entity is HSBC. So if you see them really running into problems, that'll be another cue. But again, I think the Fed will continue on their path. The same with the Bank of Canada. I mean, data in Canada is getting weaker. Of course, we know that. A lot of people are struggling in a number of different ways, but it's still not enough. I mean, the Bank of Canada on their, I love now they have a Twitter feed and they're actually trying to be active with it. And the funny thing is, if you're on Twitter, you had to have, you had to be witty, of course, right? So that's why, IceCap is very successful and, Rich is struggling a bit. But the Bank of Canada, the governor came out today with a little video basically saying, no, he's mocking you. He's saying, you know what? We're going to continue to raise rates no matter what. And that's it. So you have to expect that's where they're going to go.
Yeah, they're pot committed to this. It's like,
well, I mean, but wait a second. They're pot committed to something that I think, again, I stress, I think is a net benefit for society. It is not good to maintain interest rates that are negative below the rate of inflation in perpetuity. That only helps rich asset owners. So you and Keith, Steve, that's the only people that helps. I think the idea that we should just keep interest rates below inflation forever and that at any time we raise them, we should just immediately back off because some rich jerk feels a little bit of pain, I think is really, really, really bad. Again, we've talked about this before. There's an emphasis on income inequality. I think that's a red herring. It should be about asset inequality. And the only people who majorly benefit from sustained negative real interest rates are people who are asset rich. And it's from an economic standpoint, from a productivity growth standpoint, from avoiding a bloody revolution standpoint, it's time that those asset holders feel pain. And I think the way that, and not to mention, we talked about this as well, real interest rates are a market signal. One of the reasons why I think that Canada has such shit productivity growth is because we've kept real interest rates negative for 10 or 11 or 12 years. And the only way to make money in this country, or in the country I used to live in anyway, is to invest in real estate rather than manufacturing or industry or go get a real job or be a tradesman or whatever. And so I think, although there is pain, although this might be painful in some financial markets, on the whole, we should absolutely not be afraid of real interest rates that are positive, that are solidly in positive territory, and that they are kept there for a long time, because that's what most of our history has been. From 1970 all the way until like 2010, real interest rates in Canada were positive. And this idea that if the world will crumble if they go back there after being 10 years in negative territory, I just reject that on its face. But I would also just add,
I want to push back because I agree basically with everything that you've said. I'm just trying to look at it like strictly from like what I want to happen or what they will do. Basically, I'm struck. I mean, Keith, maybe you can chime in here, but like with debt at these levels, like how do you get the debt to GDP lower? Like, so it's you either have to go through this like very, very painful debt deleveraging, which is, mass foreclosures, bankruptcies, insolvencies, unemployment goes up. Like, does that not lead you, or basically, or you somewhat inflated away, or you just some sort of new monetary regime, some sort of great, Bretton Woods 2.0? Like, there has to be like a real resolve here, and I don't think given politics and society today. Nobody seems to want to go through any sort of pain. We have inflation today, and governments are simply just printing money and mailing people checks, as opposed to going through the pain, which is like, in order to get inflation down, we have to have people need to suffer a bit, but like nobody wants to go through the pain. And I just look at the debt levels today. I just don't see how, sustainably people are going to get through positive real rates without, again, mass foreclosures, job losses. And I think it looks like a Great Depression 2.0.
But
Which
there's no free lunch,
maybe we need to
Steve.
go through that. I don't know.
But Steve, there's no free lunch. I mean, the problem with the way that people have couched this and framed this discussion is this idea that if you keep interest rates low forever, then everything's great and there's no negatives. And if you
we
raise
basically
them,
just
it's
kick the
only
can.
downside.
You just
But
basically are kicking the can down the road further and
right.
further.
I mean, and in our introduction, I think, one of the quote that you guys have better quotes, but mine's okay too, which is this idea that the dirty little secret is that no one's gonna get paid. These bonds are not worthless, but the bonds are worth 60 cents on the dollar, 80 cents on the dollar. I mean, bond returns are minus 20%. I just don't think you're going to recover. And I think that's the bond holders, not the equity holders over the long term, that are really going to take this in the teeth. When you say debt to GDP is at X amount and that needs to come down, it's a haircut for the bond holders. At least equity holders have a claim on the future assets or on, IP or future sales growth. You can work with margins. There's in theory, dividends are paid in real terms, et cetera, et cetera. But it's the bond holders that are going to get smoked. It's the pension funds. And then so for me, that's the part where someone somewhere at some point needs to feel pain, right?
I just don't.
So
Keith, I don't know.
Now
What
we're
are
just
your
now we're just
thoughts?
negotiating. Now we're just negotiating on who. Anyway, sorry, Keith, go ahead.
I just like listening to you young guys talk about stuff sometimes. And Rich, you actually are right. The bonds are worth less, so that is right.
Was that a joke, man? That was it,
yeah,
man.
you said
You're
bonds.
1 for 3. That's okay.
You said they're not worthless. I said they're worth less. Yeah.
Okay.
Even better, I reject your rejection. See, the challenge here is that you're not going to be able, like we are the world, you're not going to be able to gradually transition from, negative real rates to positive real rates. And, everyone is happily holding hands, having a cappuccino
Right,
and
I
a
agree with
biscotti, right? That ain't going to happen. So something, a bit bad happens along that journey. And that's the journey we're taking right now. And governments will always look to, hey, we got to, blame someone. So they're always going to blame the wealthy. So for example, I don't know if you guys noticed this, but in Spain yesterday, they announced that they're going to have a wealth tax on residents or Spanish taxpayers. I don't know how they'll do it. Yeah, with 3 million euro in assets. Okay, not income, assets. There's now an asset test. And I don't know what the rate's going to be, but the IMF came out, this was probably in 2011 or 12 or 13, they came out with their recommendation that the world back then, they apply a one-time 10% wealth tax on everyone around the world. There would have been an exclusion up to a certain level. And by doing that, they said that would help, and that would then be applied to global debt. And they said that would basically reduce the debt, from way up here to way up there just a little bit. So this whole idea of a wealth tax has been tossed around now for quite some time. And you're gradually starting to see it being introduced. But Spain announced it. And I fully expect in Canada, if we continue with the current political coalition that we have, that is absolutely coming up next, because they're not going to raise taxes on lower income households. They will raise it on corporations, but the easiest one to get political points for, especially with that election coming up at some point, they're going to float the idea of a wealth tax. And if you do it on an asset base, it means, hey, you include your house and everything on it. I mean, it's just ridiculous, because how do you value the house, for starters? And, you hear the term before, the phrase, house rich, cash poor. So what do? You have to sell your property to pay the tax, and you have all these things going on. But, but again, Rich is right. They're policymakers. They're playing with a specific book. They know what they have now, it doesn't work. So they're, very quickly and dramatically trying to right the ship. And Steve, you're also right in that, we have all this debt out there. How are they going to fix it? And there's a pretty easy solution for it. And anyone in Ottawa listening, give me a call and I'll sort it out for you for a fee, of course. But there are solutions out there for these things. You're basically going to do a debt equity swap. I mean, that's what it's going to be. And because one thing about, the developed world, the debt loads are enormous, of course, but the assets that governments own, it's enormous. Like there's a lot of easy ways to fix this, but you can only fix it if there's a crash first or a crisis first. Otherwise, how are you going to convince everyone to turn in their Canadian federal government bonds, in exchange for a share of, federal lands or something like that? But that's where we're going, right? There's no easy way out. We're headed in that direction. And along the way, some markets will do great, other ones not so great. It'll give us a lot of things to talk about. And anyway, I think I think this path is easy to see. And we just have to be prepared, to go down that way.
Well, speaking of which, there's been a lot more discussions and trial balloons being floated out there. I know we've talked about it before, but central bank digital currencies are definitely coming. And again, not to be conspiratorial, they are coming. I don't know the exact role that they're going to play, but it certainly gives, if you're looking at, direct transfers to households and trying to influence economic behaviors, I mean, it's one way to do it. So I'd be very, very curious. But yeah, this is something, Rich, it seems to me is going to be very difficult to resolve. It will get resolved one way or another. I think policymakers, to me, are continuing to try to buy themselves time to try to sort this thing out. So yeah, it'll be very interesting to see. But I don't know if we switching gears here, but coming back to the the Canada front, getting, overlaying that with interest rates and everything that's happening, economic growth continues to slow. To Rich's point, financial markets might be breaking, but that hasn't yet transferred over to economic pain or sort of in the economic data, so to speak, in terms of, job losses and whatnot. But Rich, I think, what did we have? We had an update, I think, today from not only Canada's GDP, but I think we had the US as well, did we not?
Oh my goodness, you caught me off guard. I don't know anything about the Canadian GDP number because I usually ignore the monthly data. I was more focused on the population growth thing. But
you blew it.
I blew it. I blew it.
Oh man, that's a snoozer.
Yeah, it was a bit of a snoozer. Anyways, Canada's
no.
GDP,
But Rich has a good point. Yeah, Rich has a good point though about population growth and the effect on GDP. Why don't you share that with us?
Okay,
Rich?
so anyways, I'll chime in. Canada's GDP growth was 0.1%. It's basically been flat to it's basically, we're essentially at no growth. So we're not technically in recession where GDP is declining, but growth is basically more or less at zero. But massive population growth. Rich, if you want to jump into those numbers and sort of explain how that is potentially could end up masking a recession in Canada.
Well, it's definitely masking. I mean, there's different ways to calculate GDP. Again, GDP is gross domestic product. It's a flawed but extremely useful way of measuring the productive capacity of an economy. There are different ways to calculate it. There's something called the income approach, which is, it's how much quote unquote net income each of the sectors might get, whether it's wages, corporate profits, interest, income, to the government or whatever, or sorry, indirect taxes and direct taxes. There's the expenditure approach, which is the one that we're all sort of more familiar with, which is consumption, investment, government expenditure, and net exports. Yes, I actually got that right. And then there's different ways. There's another way to calculate it, which is basically taking the number, and then once you get that, so then you take the population growth, and then you have sort of the productivity growth. So you can, or like how productive each person in your economy is times the number of people you have. And then you get through that, you can calculate your GDP. And then obviously, and so, but this is what's so crazy about this GDP number that came out, and it was basically flat in Canada, is that Canada just recorded the highest population growth in 55 years. So I think it was Q2 1967. Someone will correct me if I've screwed that up. And it was 1.8% year-on-year growth, which so just to keep that in mind, so our GDP grew by 0.1%, right? Month on month, if I'm not mistaken. So basically Correct. It was flat. And so let's just annualize that figure, which is a bit naughty, but let's just do it anyway. So, you basically have, just under 1% growth for your GDP. And yet we've had 1.8% GDP growth year on year. So what that tells you is that we're already, if it wasn't for the fact that we're letting basically anybody with a pulse into this country, we would already be in a recession. I mean, so which is wild. So just to give you an idea, there was an increase of, there was 284,000, almost 285,000 people who immigrated to Canada. The Canadians' population growth grew by 285,000. The lion's share of which was naturally immigration, because we know our birth rates are basically abysmal in Canada. And so it's just actually an incredible sort of, like, I don't know if lie is the right word, but like an obfuscation. Let's say it's an incredible obfuscation to suggest that Canada's GDP growth was, again, generously flat, slightly up, when really you've had an incredible amount of population growth. Now, that's not to say population growth isn't good. There are countries like Japan whose population growth is shrinking. That's not great. Germany used to have terrible demographics. That's not necessarily great either. But make no mistake, this is not a great number that came out. And if it wasn't for the express, desire to basically just, pack, just basically invite anyone and everyone, I mean, Canada would already be, in my view, in a recession. And I think it's just a fascinating thing to remember when you're looking at these numbers, to sort of remember how they're built, where it comes from. And so there's my little piece on that.
So 300,000 people came in, right?
Well, I mean, there were some births in Canada, obviously, but okay. the vast majority of it.
And then one left.
So 94.5% of the growth was immigration.
And one left.
And one left.
Yeah. One left.
Oh my God.
One more point though on the GDP though.
Yeah.
So the number that came out, everyone, is for July. So it's the first
Right.
month of the quarter.
Right.
So we are finishing Q3 now on Friday. So and again, from our investment point of view, like the last 3 months, it's been 0.1 and 0.1. So there's not a lot of momentum kicking in here. And then we would look at other data points around the world, whether it's the Americans or Europeans and so forth. It's also pretty sluggish as well. The American GDP number that came out today, that was the third revision to Q2 for the Americans, which did confirm that it was a negative number. So
third revision.
Yeah, they revise it 3 times.
They do more than that. They'll revise it in a couple of years too. They always.
Yeah, like 5 years later, they actually go back and because they have.
I wonder whose job that is.
A very, very smart person. We'll give them credit.
What does he do? He just sits down and goes through all the receipts, or what?
No, he's a PhD in econometrics. They model it, and then they adjust the models afterwards and stuff.
They like a lot of them have glasses.
I just nerded out on you guys.
That sounds horrible.
But a lot of them have like glasses and a white shirt and a blue tie, and they sit in a locker room. That's what they look like.
Yeah.
To Rich's point, though, on the immigration basically masking like a recession or an economic contraction, right? Like that's why it's really best to look at it from a GDP per capita perspective, right? Like if basically if you want to ask, like, is your life improving? Is your lifestyle improving economically, or is it getting slightly worse? I mean, if you look at GDP per capita, I'd imagine, Rich, it's probably declining.
I think I haven't checked this one, but we'll check and we can get back to you guys next week. But I mean, listen, immigration is not bad. My parents are immigrants. They're very grateful. They worked really hard and paid lots of taxes. That's not the point. The point is not an indictment on immigration. The point is when it's to educate people and give them context. So when they look at these numbers, they understand that the only thing that matters in life is productivity growth. And another way of saying productivity growth, Steve, is exactly the way you said it, which is GDP per capita. That is what matters. Everything else is just rearranging the deck chairs on the Titanic, basically.
So let me walk you through a scenario here. I remain quite bearish on Canadian housing for obvious reasons, as Rich talked about. Positive real interest rates reprice a lot of assets, and particularly highly levered assets. So that continues. But when you've got this unbelievable immigration that's coming into the country, and all I can tell you is, like, and this is not my opinion, this is factually what's happening, is developers are doing what makes sense, and they are hammering the brakes on new development and construction. Because the way that the system works here, and particularly in like Vancouver and Toronto, which is your two major urban centers, is that developers, when you're building, let's say, a high-rise tower, any basically decent sized project, okay, 10 townhouses, 3-story wood frame building, doesn't matter. When you go to get construction financing, which is all these big developers that do, or even small, medium-sized developers, everybody does. When you go to get financing from a lender, they not almost always, they always want to see pre-construction sales. So they want to say, okay, how do we mitigate our risk as the lender here? And so they'll say, well, we typically want, on average, they'll typically want to see about 60% of the building, 60 to 70, depending on what kind of developer you are. They want to see 60% of the units pre-sold to buyers. So that way the deposits have been received. They know that at least 60% of the building has been sold. They feel comfortable to lend that money. So the developers go, well, I can't, if they can't hit 60% sales targets, or if they feel that, okay, I'm going to launch a project and I'm not necessarily sure the market's going to pay the price that I need to make this project economically feasible because rates are up and they can no longer afford these prices, they hit pause, right? Like, you're not going to go through the process of like doing a pre-sale launch, hiring your staff, building out the presentation center, spending all the money on Facebook advertising, bench stop ads, newspaper ads, to then spend all that money and realize, oh my gosh, you didn't even hit 60%. You only could sell 40%. So what happens is developers are shelving a lot of these projects right now. And the banks are obviously getting tighter and tighter on their pre-sale requirements. So just kind of understand that's kind of how the train or the system works in Canada, that this will be a lag time, right? So the stuff that's already under construction is going to come and it's going to obviously top up some of the housing that's available. But if you look, if you're projecting 3 to 4 years down the road, that's kind of when this will sort of emerge itself as a problem. So again, that's not to say there's an immediate turn in housing, but I think when you look 3-4 years down the road with immigration roughly at these levels or even close to these levels, you're going to continue to see housing crises, shortages, in my opinion.
What about rents?
I mean, I think that's the same thing, right? So you can say like, oh, the resale market's weak, but like at the end of the day, it's like, well, rents are still going up, which indicates to me that you don't have an oversupply. If you had an oversupply of housing, rents would be flat to down, which, hey, in Calgary for the last 5 years, they've been flat to down because it's very, very easy to build in Calgary, very little permit approval times, tons of land. They can just sprawl out and they build. But in these major centers in Vancouver and Toronto, where there's so much political resistance, it becomes extremely difficult to get projects approved and built. And I think, as we know, most of the immigration in Canada is flocking into these into Vancouver and Toronto, right? And so, yeah, that's kind of how I look at it, basically. Interestingly enough, actually, on my thesis, not to bore you guys to death here, but so Alberta actually had, I think, one of the strongest net migrations for young, and it's particularly for young people. If you look at the charts, net migration to Alberta by age was explosive. So you're basically seeing a lot of sort of 20 to 30-year-olds leaving some of these more expensive cities and actually going into Alberta, which is actually a complete reversal from the last 5 years. So very, very interesting, which kind of mimics somewhat, I think, of the patterns that we've seen in the US, right? Which is people leaving these very expensive, high tax states and going into like the Sun Belt and Texas and whatnot. So cost of living crisis obviously is creating migration.
Steve or Rich, have you guys seen current data on provincial population growth? Like, is Alberta booming and maybe BC and Ontario are not growing as quickly?
BC is actually still doing quite well. Ontario's definitely taking a hit. To be honest, I'm still surprised that BC does as well as it does, given the cost of living here. I mean, obviously,
Beautiful British Columbia.
yeah. So I mean, yeah, I guess people actually, it's funny. I was actually just on my street here, walking the dog, and this guy comes up and he's like, "Hey, I watch your podcast. You live on the street," kind of thing. And I was just chatting with him, and he actually had migrated from here a couple of years ago to Saskatoon. And so I chatting more and more people. He's like, "Yeah, you know what?" He's like, "I gave up like a 5-bedroom house, 3-car garage, and he's like, now I'm renting like a condo here in the city, and not at a cheap price." So people surprisingly are still giving up sort of standard of living, I suppose, or larger houses to come to BC.
Well, I've actually got the data in front of me because this is what I do and I love charts. So the data goes up, is monthly data, and goes up to June, end of June. And PEI, with its all of 200,000 people, has had a population growth of 3%, which I know it doesn't sound like a lot, is population terms is an incredible incredible number. Nova Scotia is second with roughly 2.25. British Columbia is third with 2%, almost exactly year-on-year population growth. And then you got New Brunswick, and then Ontario, which is 1, 2, 3, 4, 5 in fifth place with just over 1.5%. So
I was talking about, basically.
So BC, which is the population of BC is 5.3 million. To have a population growth of 2% is still significant, is quite a number.
Yeah. And that number I was talking about for Alberta, for example, is I believe was a interprovincial migration.
Yes,
so
that's right.
People leaving one province, and that's what we're
right.
kind of seeing in the data is people are leaving, for example, Ontario and going to PEI or whatever that's more affordable, particularly during the pandemic. But again, you still have these newcomers that are coming in here from various parts of the world, flooding into Canada. And again, I think most of them come to, where is the economic opportunity? Yeah, the cost of living is extremely high, but if you're going to go get like a half decent job, it's the opportunities in the GTA and in Vancouver and in these large major metropolitan cities.
There she was.
So that's enough about Canada, though. What a boring country.
Oh no, yeah. ArriveCAN. I can't believe they're ending, or we have to do it. We have to talk about it. The most important, best rated app on the web is no longer. I was very sad to hear about this.
Yeah, we might actually have a hope now of surpassing them. No, yeah. So anyways, yeah, obviously I think everyone here is listening to this pod is probably well in tune, but the federal mask and quarantine and vaccine stuff, I guess, for air travel and whatnot is going away for October 1st, I believe it is. So the ArriveCAN app is no longer necessary. So we might finally win one here at the Loonie Hour.
I think, though, I think that's a good example, and this is what I believe. If you disbelieve it, then you're just wrong. But I think that politically now with Poilievre, leading the blue shirt guys, as I think Steve, you mentioned this.
No, it was
last
Rich.
time. Or Rich, okay. Last
Good call,
time,
Rich.
You're going to start seeing. The red and orange shirt guys start trying to swing a bit more back to center. And I think that's one of the first steps with it. Or if not, it's a lot of irony attached to it. That's it.
Rich, that was actually a really good call. When you said that, I was kind of like, I don't know, I'm pretty skeptical. But like the moves that we've seen from the federal government over the last several weeks. Really, since that call, maybe they're listening to this pod.
I think they are, because they I think one of our rants was like almost verbatim ripped off by a certain political leader.
Everything, yeah. There's been a lot of changes at the federal level in the last couple.
No, I would
of
never
weeks.
presume to be that popular or important, but it was a nice coincidence.
Was it? Oh, it was the gun. It was a tweet with the bad jokes, right? So it was me.
Yeah, it was definitely that.
Yeah.
What else we got? What else are we looking at? I want to bring one more point up to sort of touch on. This is an ongoing debate, and there's people again that are going to hate this, but we talk about Canada's basically flat GDP growth. I mean, you can go across, the world, right? GDP is weakening. Obviously interest rates are going up. Things in the financial markets are starting to break, and that's going to slowly trickle through into the rest of the economy. I think we're seeing more and more signs that CPI inflation is going to come down maybe quicker than people want to believe. Again, I know people don't like that view, but this is from our good buddy there, Keith, from Ritesh Jain, who quoted the Macro Strategy Partnership. Their note there, it says the Canadian 3-month annualized CPI has already fallen to 1.86%. That's below the 2% midpoint of the central bank's target rate. So again, I know it's just a 3-month annualized, not perfect, but that's showing us at 1.86. We're seeing up various commodities all coming off quite drastically from their peaks earlier this year. I've got this great follow, by the way, if you're looking for data on freight rates, and because obviously shipping and freight rates are basically an indicator of global demand, shipping goods across the world. So Craig Fuller is a great follow on Twitter. His quote, he says, "I've never seen freight rates drop as fast as they are on the ocean market right now." Of course, a lot of their pricing is back down to early 2021 levels. So the stories of freight rates 10xing during the height of the pandemic, those have all basically retraced back to what they were pre-pandemic. And obviously, like I said, commodity prices, to me, that I just think, Keith, I don't know, Rich, I don't know if you guys have any comments, but to me, I think central banks are doing their job, which is they are raising rates so aggressively that demand is getting slaughtered. And I think that is ultimately bringing down inflation, which is their target, which is their goal. So mission accomplished, I suppose.
Well, I wouldn't be that congratulatory for them. I think a lot of things, well, it's a complicated global economy. It is happening, but let's be clear though, but the Americans as well as the Canadians, and they said, we're going to keep raising rates. Just because it comes down lower, it doesn't mean we're going to stop. Because remember, we've had this discussion now, not just us, but the market maybe 3 times now over the last month about, this infamous pivot that's going to happen. And they keep coming out and said, guys, you're not listening to us. Who was it? Was it Clinton or Bush that said, read my lips that time? Well, you guys were too young to.
I think it was George Bush. Oh, no, it was Clinton when he said, I did not have sexual relations with that.
Oh, that's what it was. Yeah. But so anyway, I think you have the central bank they're saying, guys, like we're not going to do that. So it sort of ties into now. So we have the Bank of Canada coming out on October 26th. So, roughly a month from now. And so right now we're at 3.25 in Canada, and the market is pricing in another 75 basis points. And that's been up as high as 100, and now it's back down to 75 again. So it's
the market's pricing 75 now in October.
No, 50 for October, and then another 25 either Dece or January coming up. And so this is the big game, right? The market is now starting to price in, hey, we're now going to peak with rates. And again, that doesn't mean they're going to start cutting right away, because it usually takes about 8 to 10 months before a central bank starts to cut. But we're into that line, and maybe that aligns with the inflation comments that you guys both brought up then. So we're going there. But again, they've been very clear, and Powell couldn't have been more clear than the presser they had at their last Fed meeting. He basically said, you're going to feel pain with your house valuation. You're going to feel pain with your stock portfolio, your bond portfolio, your bonus from work. Maybe you might lose your job. Some folks might get hurt, but we're going to keep raising rates because it's more important than anything to control inflation. And again, it's irrelevant whether we believe them hiking rates will cause inflation to come down. I think you do have other factors at work here. And but the point is, that's what they're telling you. That's what they're going to do.
So can I just add a little piece to that, which is that the U.S. consumer, in my view, I know Keith might not agree on this, but I think the U.S. consumer is, again, the pivot here is the fulcrum on where this all rests on, because I think the U.S. consumer remains really strong, stronger than I think people would have expected with this kind of rate hike. And, earlier, Steve, you're saying, a lot of the economic stuff hasn't broken. I would submit to you that that's true. The ISM non-manufacturing survey is still at 57, which is high. We haven't had any claims data come off, which is the sort of the most sensitive labor market data come off. The wage growth is still strong. JOLTS number is still strong, but also I think there's lots of financial market data that is nowhere near broken. If you look at high yield spreads, yes, the high yield number is high, but the spread over, again, which is like the credit spread or the term premium or whatever you want to call it, over the treasury bonds is still well within its long-term average. Even if you look at, so if even the Italian spreads, which we've talked about a lot, it's up, but it's still below where it was in 2018, 2019, and even 2020. Over the German, it's still only 2.3. The Spanish one is only, 1.17. So even though, yes, they're, obviously the UK, something broke there. But as far as the economic data, the consumer data, the labor market data, things like TED spreads, which I know are no longer popular, but the OIS option adjusted spread, which is the interbank lending numbers, are still relatively tight. High yields okay. So this is the problem with people hoping and praying that the Fed pivot, as Keith laid out. I think there still really hasn't been that much pain. Lastly, I'll even say that there's there's high yield and investment grade ETFs that people look at as sort of a proxy for where we're coming and how much and that's only at 2019, 2020 levels. And so we really haven't had that much pain, which is just kind of remarkable. So I think that's more to come.
Yeah, I think it's interesting, Rich, because if you chat with the average lad out there on the street, they're not, watching podcasts and monitoring markets and stuff like that. And if you said, you're not concerned, but what about, this and that, they'd look at you like you're crazy. Like, I think, Rich, you said the other day, like was it Lisbon? I think you said, man, it's booming here, and you're in Halifax, you're walking around like it's booming, if you go into the city. And same with Toronto and Vancouver and stuff like that. But now because remember, the financial world, the one that we're talking all the time, we're looking into the future all the time. We're pricing risk that may happen or it may not happen, and it'll get repriced again. But we have everyone in the world now is going to get an investment statement coming out for September the 30th. And, most people look at it online all the time or on the phones. They can see what they've made and lost. But there's going to be a lot of this confidence adjustment. It's going to come down. So pension funds will have it. Banks are definitely going to have it because they have AUM and P&Ls they're running. So maybe, again, like I'm a bit I'm optimistic for opportunities in the financial markets, but economically, I'm pessimistic. I think we're going to start hitting some low confidence numbers coming up. And, again, like I can't get over it. It was the Brits were the ones that experienced the first. And if I had to rank them, I wouldn't even had them on the list, truthfully. I would have said, hey, like they don't qualify. But they did. And that's what's so interesting right now. Like all the risk is out there. So I do believe
it's a mess, by the way. Apparently, I guess all their lenders are pulling back loans that they were going or promising to make for potential home buyers because obviously the volatility in their bond market, right? So
they have to watch the liquidity, right? They have to watch that. And but with Canada, like I continue to see and expect the risk that we have in Canada is from outside still. If the rest of the world recovers, and it never got any worse than this now, even it went sideways for a few years, I think in Canada we'll manage it. I think there will be a little bit of downside in some markets and stuff, but you're not going to get this like epic bank crash and stuff like that. Like we're nowhere in that discussion area. I do think though that the next near-term risk is going to be Italy. I am not going to be the least bit surprised if we wake up at any time in the next 48 to 72 hours and we discover that Brussels and Frankfurt have decided they're going to turn the screws on the Italians.
So I'm surprised the spreads are so tight, actually, funnily enough.
Because they'll try to save the Germans first. Yeah. They'll try to save the Germans first, of course. I mean, that's what they're doing. But again, because you will get saved if in the EU, if you play the game, then you're part of the team. Yeah, we'll look out for you, Rich. We like you. You're one of us.
So we actually have a very important question as I want to wrap this show up. But we've got a very important question actually from one of our listeners. A lot of upvotes on this one, so kind of curious your guys' quick thoughts on this. But it was based off a tweet where I said, Keith, you had nailed the US dollar wrecking ball call, that again that the US dollar was obviously going to start breaking things, and that other central banks are now having to sort of play catch up just to sort of maintain their currencies or try to keep up, so to speak. So we were asked one question that says, I really think you guys need to talk more about the dilemma facing the Bank of Canada right now. I'm not sure many Canadians really understand that they have no choice but to keep pace with the Fed unless we want to see the CAD down, he says 15% in a month, which might be an exaggeration, but yeah, that was really the question is what's your opinion on that, Keith, first and foremost, if you want to take that one. But the premise is the Bank of Canada having to keep pace with the Fed, otherwise the loonie just gets wrecked.
Did you want to have a go on that first, Rich, and just sort of rephrase the question so I can?
Sure, I can buy you some time. So, I mean, there's like something called interest rate parity, which is I think what he's like sort of touching on, which is, you basically have some kind of parity between your interest rate, long or short term, and your currency. And, and there's like an implied interest rate parity, and then there's a forward, there's all kinds of different shit that I forget about and that I learned about in the CFA and then I've forgotten. And I think but I mean, I don't know if that's necessarily at play here. I think that there's oil at play. I think that there's GDP growth and productivity at play. The idea that it's going to collapse 15%, I don't necessarily think that that's true. Just because I think we've already fallen quite a lot. But the question really is, whether or not Canada will have to increase its target rate to follow the US or suffer from a significantly lower Canadian dollar. I think the easy answer is probably yes. I think the harder answer is that it sort of already has. And I think that I guess I don't know. Sorry, I waffled like crazy. Hopefully I bought you enough time, Keith.
Yeah, you did. Thank you.
Okay.
Actually, I've been waiting I get a weekly delivery of US dollars to my door. So it was just arriving. I had to put it in the back room.
Which room do you keep it in?
Yeah, we call it the King Dollar room.
Yeah.
So the answer to that, because now what I would do is what I think the Bank of Canada is going to do. They are not at that stage where they're trying to match the Americans with rate increases to try to maintain the Canadian dollar at a level. Like, again, from what I hear from the Bank of Canada, they are not hitting the panic button. If they are, it's on the loan portfolios. It's not on the FX side at all. That could absolutely happen at some point. But as you said, Rich, Canadian dollar has been one of the best performing cross rates over the last year. I think so. You might have CAD, Brazil, peso,
Mexico.
almost. Yeah, absolutely. The top three. my concern, so if I'm running like a currency fund of some sort, and I'm not based in Canada, so I don't have any alliance to that, what I would be doing now, I'd be, closing the big winners, and I'd be allocating so that I am short CAD, Brazil and peso, because those are the ones that have the opportunity, to come down a lot harder, if we go there. And we bought oil this week.
Hooray.
No, I'm just messing with you. We didn't do it yet.
I didn't believe you.
I know it is coming up soon, but that
there's
does tie
another-
in with Canadian dollar, right? So that's something to think about.
There's another angle to this, which is kind of more cynical angle, which is 85% of our exports go to the US. This obviously includes 97% of all the crude oil we produce because we refuse to build any freaking refineries. We have the same refining capacity that we did 25 years ago, which makes me very angry. But anyways, so the fact that the Canadian dollar goes down a significant amount relative to the US probably makes our manufacturing and service sectors that sell to them significantly more competitive. So it's not necessarily clear that that's an undesirable outcome. Just saying. I don't know.
I think that's
So I remember a few months back when when CAD was in the 80-cent range, and I said, you know what, I think we'll see a 6 number in some of it at some point soonish. So here we are now at like 73 cents, maybe here right now, 72.90. And I think we'll get a bounce. I think the US dollar has been ripping. I think you might get a pause here for a little bit, but then it will start going stronger again. But all these currencies, we can see a 6 number in front of the Canadian dollar pretty soon. And again, like we're headed in that direction. So to sum it up, like real nice and neat, there's a lot of noise this week, with the Bank of England coming out and rescuing the bond market. But like nothing has changed, guys. Nothing has changed for the better here, and so we should prepare, for more opportunities, as we like to say, in the financial markets.
boom.
hockey season starting. That's good.
Well, I think it's a good place to wrap it up. As always, we appreciate your support. We ask that you still leave positive reviews for us despite ArriveCAN being shut down. Continue to share this episode with at least one friend or family member. But we appreciate your support as always, and we'll see you next week.